Reserve, but I want to even zoom out further than the Federal Reserve and look at the global landscape. We sometimes we tend to focus on the Federal Reserve because they are the most important central bank, but we can get pretty myopic in that view and lose sight of what's going on in the rest of the world. And I really want to talk about the macroeconomic landscape in the perspective of energy prices and what's happening in the energy markets. If you guys are familiar with what's going on in Europe right now and the Ukraine-Russian war and what that's done to the European energy markets, that energy prices, electricity prices in Europe have gone up, about 20-fold. So that's pretty dramatic, and that's really putting a lot of strain on German industry and French industry, and they just really don't have the capacity to deal with that. And it's one of those scenarios where there's no, there's no clear resolution to that. I mean, the clear resolution is to engage in trade with Russia again, but they have an alliance with America, so they have to play both sides at the same time, so to speak. Right now, they're not. Those trade routes are being shut down and redirected to the east, and you have a global landscape where global trade is being restricted, being isolated, and basically you have a scenario where the global west is fighting an economic war with the global east. And the tough part about that is that the global east has the energy supply. They have more energy than the west. And so I want to put forward like a unique notion that the real currency in the world is energy. Energy is essentially what we need to create any economic activity that we value or produce even luxury goods that we value. Every economy depends on energy as its underlying currency. Now, of course, fiat currencies can buy energy, and it's useful to that extent, but ultimately what we need, what the building block is energy. So if we think of energy as the economic currency that everybody really cares about, then what we care about is our ability to acquire energy, not necessarily fiat currency, but our ability to acquire units of energy. So if you look at the world from that perspective, you can see how crazy things are, right? Now the West America is not directly at war with Russia. They're funding Ukraine and using Ukraine as a proxy army to fight a proxy war with Russia. But they are very much fighting a real economic hot war with Russia. They seized Russia's forex reserves, and they're basically holding China's forex reserve hostage right now. So, and also you have, sanctions and tariffs, and more than tariffs, you have sanctions directly on Russia and anybody who's doing business with Russia. So you have these global trade routes being disrupted, being redirected, and you have a situation where, these other countries, countries who maybe aren't America, China, or Russia, or allegiances are clearly defined, people like in South America and Africa and Europe, they're being forced to choose sides, right? And on one hand, you have the West, which operates, the largest, they're essentially the policemen of the world. They operate the largest military in the world. And, for better or worse, people, believe that if they ally with America, that America will provide for their national security. And it, it's a good argument, and historically America has performed that role, but, anytime an empire gets very extended, their ability to, make good on that promise is severely diminished. So on one hand, you have the national security benefit of allying with America, and on the other hand, you have the energy benefits of allying with Russia and people trading with Russia. So, at a certain point, if America is unable to defend these countries, and they're suffering from severe energy shortage, and America isn't able to defend them precisely because there's not enough energy to go around, and they have to conserve it and use it and prioritize it for what's really valuable, which is protecting themselves, then that's going to hamper their ability to, make good on their end of the bargain. So I think the next decade will probably be defined by seeing, geopolitical surprises, right? Different countries breaking ranks from America and siding with Russia and people, the Eastern Bloc, precisely out of necessity, right? Because they have no choice, right? They need energy to perform the basic functions of society, to keep the lights on, to feed their children, to, run the farms. Like it's very basic level stuff. And, allying with the Eastern Bloc, Russia and China, they may also offer, protection and national security to these countries who are willing to come into the fold. So, and that can be a situation where you have a real domino effect, right? Where, people are very, countries are hesitant to step up. But once you get, one step up and then a trend start, then it can accelerate pretty quickly. So, I guess, what does that mean for the markets, right? We're ultimately concerned about the markets. Well, if you see things from the perspective of energy, I really want to revisit this because I think this is the primary focal point of this video, which is that the economic currency of the world is energy. Then you want to think about the value of goods and services priced in energy, right? How much energy can you acquire? How much energy can you store? How long can you store it for? And that's really where Bitcoin comes in, right? And really where, fiat, the weaknesses in fiat currency is very laid bare, right? Because fiat currencies don't have any realistic connection to energy production, right? It doesn't cost any energy to create them. It doesn't, there's no work required to create a fiat currency. You can create an unlimited amount and then use those to lay claim on energy that, actually takes energy to produce and extract from the earth. But with Bitcoin, it's different, right? And with Bitcoin, there's a certain energy requirement to mine it from the network, and there's no way to acquire Bitcoin without expending energy. So in a way, you can think of Bitcoin's real price as the kilowatt joules per hour it takes to mine it, right? So it's not necessarily its fiat currency price that's important. It's how much energy does it take to acquire that Bitcoin, right? If you're mining the Bitcoin. And it's also, a lot of people might not really think about things like that because they don't, why do they care how much energy takes to mine a Bitcoin? They just want to hold Bitcoin and want to see it go up in price, right? Well, if you're a nation state or a very large entity, in the future, not necessarily right now, but there will be times where the amount of circulating supply that's available for sale on the market is just not big enough for them to acquire supply. And in those circumstances, the only way to acquire supply would be to mine it directly from the network. So, you would necessarily see a lot of nation states, build out state-sponsored mining operations. And in that scenario, they would be, from a national security perspective, be very concerned about, how much hash rate is their nation producing relative to their rival nation or their enemies, right? Which would be a very closely kept national secret. But that's something they'd be extremely concerned with. And of course, they would be concerned with how much energy it takes to mine Bitcoin from the network. So if we think about, energy being the basic currency of economics, you would want to naturally acquire, oil, natural gas, all those things. If you have excess savings, right, that you can store, right, for the future. You don't want to store it in fiat currencies, right, because they lose value over time. You don't want to store them in U.S. Treasuries, right, because the U.S. government has, demonstrated a willingness to seize them if you're a nation state. what you would want to save them in is energy products, right? Or something that reflects the cost of energy, which, obviously is energy itself, right? Like oil, natural gas. So you would stockpile oil, natural gas, commodities, foodstuffs. But, things like oil and natural gas, there's only so much you can store, right? You can't store them indefinitely, and you can reach capacity, right? So there's a certain point where your ability to save in energy terms is very diminished, right? You can only save so much, but you can store in the Bitcoin network, right? You can store even those excess savings beyond, your oil and natural gas needs. You can use those either to mine Bitcoin or buy Bitcoin directly. And in a sense, that is a way to store monetized energy in a way that has no expiration date, right? It doesn't expire. You can store Bitcoin indefinitely. You can store it for hundreds of years. And then, if you ever need to replenish your stores of oil and natural gas, you can do that very, very easily using Bitcoin. You just convert that stored monetized energy into real energy. And over the long term, Bitcoin should, the value of Bitcoin, the fundamental value of Bitcoin should trace energy prices. So if you believe that, energy prices are probably going to go up over time and you're bullish on them, then you would naturally be bullish on Bitcoin as well. So now to kind of move on past that and kind of re-get into like different economic principles at play, I want to revisit the what the common narrative is right now with the Federal Reserve and raising interest rates. People have a perspective that, the Fed is going to keep raising interest rates until inflation is down to 2%, and the dollar will keep rising, and that's somehow good for America. Well, it's not good for America for a number of reasons. One reason being that the higher cost of financing debt makes it very difficult for the U.S. government to stay solvent. At a certain point, they're going to have a hard time paying their debt. But beyond that, I think there's sort of this idea that if the the U.S. dollar just goes up parabolically and continues to accelerate in value, that is somehow good for America. One example of why this is not true is because, as the dollar has been the reserve currency and, say, for example, China has devalued its currency, the Chinese yuan, relative to the dollar, well, what's happened in the wake of that, right? The dollar has strengthened relative to the Chinese currency, and all the supply chains that once existed in America have migrated to China. So even if America wanted to fight a war with China, they couldn't do it because they would rely on the supply chains that exist in China to fuel that war. So, at a certain point, there will be a national interest for, the Federal Reserve, the U.S. Treasury, the U.S. government to, at some point, devalue the dollar as a way to bring those supply chains back into America, right? And the reason for that is because if you devalue your currency relative to another fiat currency of a different country, you increase the competitiveness of your exports. And that's why if you devalue your currency, you'll tend to accumulate more and more production capacity within your own domestic borders. And for a global order where you get increasing balkanization and breakdown of global trade, you can't rely on foreign trade for all your needs, your basic needs, right? We can see that now with the semiconductor shortage in America. America, depends on Taiwan for all their semiconductor needs. And that's a major, major, major national security threat. So, and every country has the same interest in a balkanized world. there's all a shared interest to devalue their own currency. So when the dollar is ripping and going parabolic, you have to keep in mind that it's going parabolic relative to other currencies that are devaluing at an even faster pace. But there may come a time where the dollar is devaluing at an even faster pace than other foreign currencies, right? The good scenario where that could happen is, if the Federal Reserve, in order to maintain the U.S. Alliance with Europe and not have them break off and make peace with Russia and, trade with Russia for cheap energy, there may come a point where the Federal Reserve is forced to step into the foreign currency markets and directly intervene. Sell dollars to buy euros so that they can, the European Union can turn around and, sell their euros and buy energy without hyperinflating their currency. Right? It's a scenario. And if you play it out to its nth degree, I've run through the scenarios many times, and I really see the energy crisis in Europe sort of playing out in that binary faction, right? Well, there's really three scenarios, right? They can refuse to ally with Russia, the Fed doesn't intervene in the currency market, and they hyperinflate their currency to acquire energy. That I don't think that's the most likely scenario. I think that the two most likely scenarios is that the Fed either intervenes sooner rather than later to prevent that hyperinflationary scenario of the euro. And remember, if the euro hyperinflates, then you get populist leaders in Europe who, run on campaigns of breaking away from the EU, and it's only a matter of time before one of them actually does it. And then you have a country like, say, Italy, who breaks off from the EU and, basically defaults on their debt in euros and then issues a new currency and pays back their debts in this new currency that nobody wants, right? And if that happens, then the entire European Union faces a banking crisis. And that would just be a global financial crisis. So there's a lot of incentives for the Fed to intervene, purely financially, right, to preserve the financial markets, but also, from Washington's perspective, as a matter of national security, to preserve their alliance with Europe, who they can use as a pawn to fight Russia. So, again, if you want your allies to, serve as your fodder to fight your enemies for you, you need to make sure that they have energy to heat their homes, right? Or they're going to defect on you. They're going to side with your enemy. And really that's what's going on here. But, ultimately I just don't think it's, I don't think that the dollar will maintain its reserve currency for very long. And the reason why I think that is because of essentially what happened in February of 2022. Now, if you guys aren't familiar with the significance of that date, it's basically the date when Russia invaded Ukraine, but that's not what's significant here. What is significant is the U.S. Treasury froze and seized the Treasury reserves of Russia. And that was like a shot that rang out across the world. Prior to that day, U.S. Treasuries were considered pristine collateral, right? That you could rely on them in times of crisis, right? They were the best asset in times of crisis because they were supposedly the most liquid, and you want the most liquid asset that is, censorship resistant in a time of crisis. And that's what U.S. Treasuries used to be. But, now with the element of censorship resistance and liquidity deteriorating in the Treasury market, they're no longer, resistant to theft and seizure or liquid. So, but really what we're focusing on here is their vulnerability to theft. So after those funds were stolen, you've got China sitting there thinking, they're one of the biggest holders of treasuries in the world. Although they've been trying to roll off their balance sheet for a long time, they're still the largest holder. And they're thinking, if they look at Taiwan sideways, all their treasuries will be seized. So, the U.S. is really, they just stabbed the knife through the heart of foreign treasury demand with that action. And really, it really, in my opinion, has disrupted the treasury market beyond repair. It's going to be very difficult to, generate any kind of foreign demand for treasuries. Now, I know people will say, well, there's a shortage of dollars because there's so much dollar-denominated debt. Yeah, that's true for this credit cycle, right? People need dollars to pay their dollar-denominated debt. But what about the next credit cycle? Will people be loading up on treasuries that they know can be stolen and that they know have caused them so much pain in the past? I seriously doubt it. So if the U.S. Treasury can't generate foreign demand for treasuries, right, somebody's got to buy the U.S. Treasury debt, right, for the U.S. government to fund its operations. So that leaves domestically, right? So I think you'll see a lot of, capital controls and restrictions and different tax incentives domestically to compensate for the lack of, foreign demand or the drop of foreign demand. And that will take the place of, increased reserve requirements for commercial banks, also, tax benefits for buying government bonds. They'll have great marketing for it. They'll be like, buy government bonds. You get this great tax bonus and it's risk-free. Well, of course, it's not risk-free. There's probably going to be very significant inflation in the future, and a very significant reality of sovereign default risk. But, a conversation I was having earlier with somebody was, people tend to, the current narrative is that the Fed will keep raising interest rates and that the global asset bubble will deflate as nominal interest rates rise until, equity valuations and debt valuations all, crash and, to some level that's way lower than it is currently. Well, the thing that they're not accounting for is that real rates are still deeply negative. And what are real rates? Real interest rates are when you take the nominal interest rates. So if you take the current federal funds rate, which is 3.25%, you take the nominal interest rate and then subtract it by the rate of inflation, which is much higher than the government stated rate of inflation, which is, roughly 8-point-something%. The real rate of inflation is, probably 20% or even higher. In fact, if you measure inflation or CPI in the way they did back in the 90s, inflation would be at 20%. So the unit of measurement is constantly changing. It's a long way of saying that, the real rate of inflation is significantly higher than the nominal interest rate rises. So that's a very important perspective to consider. So if, as long as real interest rates are negative, the government can deleverage its balance sheet and the government can, get debt to GDP much lower than it is, right? Even if nominal interest rates increase significantly. So nominal interest rates could rise to, you could have an environment where they rise to 15%, but inflation is running at 30%. And in that scenario, real rates are still negative 15%. So, and nominal interest rates have risen, but in that scenario, you also have incredible inflation. So, that's something I think people don't really think about often. If you look back historically and look at inflationary time periods, you'll see that, interest rates also rise dramatically during those time periods because, of course they would, because, investors demand a higher yield when rates of inflation are higher for obvious reasons, right? Because they need to bridge the gap. But so what are the carry-on effects of that, right? If you do have persistent negative rates for a long period of time, engineered by the government so they can delever their balance sheet, well, if you do have a breakdown in the Treasury market as a global store of value, I don't agree with the line of thinking that will mean a global asset deflation. I strongly disagree with that. I actually believe that would lead to a very large asset inflation, because the debt market would stop being a store of value or collateral, and that capital would move into the equity market. So you'd have a switch from the debt market into the equity market that would be very significant and very phase shifting. And people, of course, people would be like, well, we already have an equity market. The equity has already been in a bull market. Well, what I'm talking about is the size of the markets, right? So right now, the debt market is, the bond market, if you combine sovereign debt with corporate debt, that the debt market is orders of magnitude larger than the global equity market by, factors of 10 and 20, even 30. So it's just a way bigger market. And I think my personal investment theory is that we'll see that skew start to reverse. Of course, it won't reverse, automatically or right away, but I think we'll start to see, capital flow out of debt into equity as, people stop using sovereign debt instruments as savings. And then you start to see that skew reach parity between the debt and equity markets. And then at some point, the equity markets to become larger than the debt markets. I know that sounds a little bit unbelievable, but, that's historically what we've seen in these type of environments. Things can get very crazy as capital chases, returns to, compete with inflation. Now, I know that, no one's going to resonate with that message, because the current narrative is that, if the Fed raises nominal interest rates, 0.5 basis points, that the whole world's going to collapse, even though negative rates are negative 15%. So I just think, seeing the lens of the world through real interest rates, taking nominal rates and subtracting the rate of inflation, really helps filter out all that noise. Debt instruments only make sense when rates are positive, real rates are positive, right? So say if inflation was at 4% a year, but you could get a debt instrument yielding 7%, you'd have real rates of 3%, and then that would be an attractive investment, right? You don't want to be a lender in an inflationary environment, which is what you are if you buy sovereign debt, right? You're lending to the government. It doesn't make sense to do that if real rates are deeply negative. It just doesn't make sense. And, so tying it back to the energy markets, I personally think that we'll see an explosion in, equities, energy, everything that, any tangible good, any commodity. And I think, as we enter a period of, persistent negative rates, it's going to be very inflationary, and it's going to be very financially repressive. People will be forced into certain investment vehicles by their governments, depending on the amount of, capital controls that are there. And I think, ultimately, in the grand scheme of things, whatever country or nation is able to best secure their energy needs is going to come out on top, at least in the near term, until there is some type of major technical revolution that changes the playing field, so to speak. And that could be something like nuclear fusion, or just some type of energy production innovation that, either people are talking about now, but probably something that nobody's even talking about at this point. And that's pretty cool to think about. I think, we'll probably live to see that. Technology is moving at an exponential pace. So, it's hard to predict exactly when those innovations will come. But we could probably say with a good degree of certainty that they'll come sooner than expected, rather than later than expected. So it's an exciting time to be alive. There's a lot of different things going on. Just a deep dive into the macroeconomic landscape. I'll do another upload on this type of topic. Just let me know if there's any